everyone, it's Imran. I know many of you want to build wealth and achieve financial freedom, and stock investing is one way to do it. That's why I created this video, to break down the basics of stock investing in a way that anyone can understand. By the end of this video, you'll have a solid foundation for navigating the world of stock investing. So grab a notebook, get comfortable, and let's get started. Before we dive into stocks, we need to talk about your financial foundation. Think of it like this. You wouldn't start building a house on shaky ground, right? The same goes for investing. First and foremost, do you have an emergency fund? This is crucial. You need 3 to 6 months worth of living expenses tucked away in a high-yield savings account. Why? Because life happens. Unexpected expenses pop up, and you don't want to be forced to sell your investments at a loss. Next up, budgeting. You need to know where your money is going each month. And speaking of freeing up cash, let's talk about debt. High-interest debt, like credit card debt, is like a weight dragging down your finances. So before you even think about investing in stocks, create a plan to tackle that debt. Now that we've covered the financial foundation, let's dive into the world of stocks. What exactly is a stock? Simply put, it's like owning a tiny piece of a company. When you buy a stock, you're buying a small ownership stake in that business. Think about a company like Apple. Millions of people around the world own Apple stock. That means they own a tiny fraction of Apple. As the company grows and becomes more profitable, the value of your stock can increase. And when that happens, you can sell your shares for a profit. Of course, it works the other way too. If the company doesn't perform well, the stock price can go down. That's why it's so important to do your research and understand the companies you're investing in. Stocks represent ownership in businesses, and their value can fluctuate based on a company's performance and other market factors. Before you get too excited about the potential for big returns, we need to address risk. Yes, stocks have the potential to generate significant returns, but they also come with inherent risks. The stock market is inherently volatile. Prices can go up and down, sometimes dramatically in the short term. One day, a stock might be up 5%, and the next day it could be down 3%. A lot of factors can influence these price swings, like economic news, company performance, and global events. Remember, the stock market is driven by supply and demand. As a beginner, it's crucial to understand that investing in stocks is a long-term game. It's not about getting rich quickly. It's about building wealth gradually over time. The stock market has always trended upwards over the long term, and staying invested through the ups and downs is key to building wealth. Ready to start investing? The first step is to open a brokerage account. Think of a brokerage account like your gateway to the stock market. It's where you'll buy and sell your stocks. There are tons of brokerage firms out there, both traditional ones and online platforms. Do your research, compare fees, and choose one that aligns with your needs and investment style. Once you've got your brokerage account set up, it's time to start picking stocks. Start by thinking about companies you know and love, businesses that make products or offer services you believe in. But remember, just because you like a company's products doesn't automatically make it a good investment. Look into their financials, research their management team, and understand their competitive landscape. If you're not comfortable picking individual stocks just yet, there are other options like ETFs, which we'll discuss in a future video. Let's talk about investment strategies. For beginners, I recommend keeping it simple and focusing on the long term. One of the best strategies for new investors is dollar-cost averaging. Instead of investing a lump sum of money all at once, you invest a fixed amount of money at regular intervals, regardless of the stock price. This helps you buy more shares when prices are low and fewer shares when prices are high, which can lower your average cost per share over time. Dollar-cost averaging goes hand in hand with long-term investing. Remember, investing in stocks is not a get-rich-quick scheme. It's about building wealth gradually over years, even decades. By investing consistently and staying patient, you're giving your investments time to grow and ride out any short-term market fluctuations. The stock market rewards patience and discipline. Let's talk about managing risk in the stock market. One of the most important concepts to grasp is diversification. Diversification means spreading your money across different investments to reduce your overall risk. If you invest all your money in a single stock and that stock plummets, you're in trouble. But if you have a diversified portfolio that includes stocks from different sectors, industries, and even asset classes, the impact of a single stock performing poorly is significantly reduced. So, how do you diversify your portfolio? First, don't put all your money into one stock or even one sector. Instead, invest in companies across different industries like technology, healthcare, energy, and consumer goods. You can also diversify by investing in different asset classes. Stocks are just one asset class. You can also consider investing in bonds, real estate, and even alternative investments like precious metals or cryptocurrencies. Diversification is your best friend when it comes to managing risk in the stock market. Once you've started investing and building your portfolio, it's essential to review it regularly. But here's the thing, I'm not talking about obsessively checking it every day. Constantly watching your portfolio can lead to emotional decision-making. So, how often should you review your portfolio? A good rule of thumb is to do it at least once a quarter. During these reviews, take a look at how your investments have performed, assess your asset allocation, and make sure your portfolio still aligns with your overall financial goals. Have your goals changed? Has your risk tolerance shifted? Do you need to rebalance your portfolio to maintain your desired asset allocation? Investing is a dynamic process. Your portfolio should evolve as your life circumstances and financial goals change. By regularly reviewing your portfolio, you're ensuring that you're still on track to reach your financial destination. One of the biggest challenges in stock investing is dealing with market volatility and our own emotions. It's easy to get caught up in the hype when the market is soaring and panic when it takes a downturn. But emotional decision-making is the enemy of successful investing. When you let your emotions dictate your investment actions, you're more likely to make impulsive decisions that can hurt your portfolio in the long run. So, how do you stay calm when the market gets bumpy? First, remind yourself that volatility is normal. The stock market goes through cycles of ups and downs. Focus on your long-term investment plan. Remember why you started investing in the first place. Avoid making rash decisions based on fear or greed. Staying disciplined and sticking to your plan is key to navigating market fluctuations and coming out ahead in the long run. The beautiful thing about investing is that it's a lifelong journey of learning. The more you learn, the more confident and informed investor you'll become. There are tons of incredible resources available to help you expand your investment knowledge. First off, there are some amazing books out there written by investing legends. These books can provide you with invaluable insights into the market, different investment strategies, and the mindset of successful investors. In addition to books, there are countless online courses, webinars, and workshops dedicated to teaching people about investing. Find what works best for your learning style and dive in. Don't underestimate the power of community. There are tons of online forums, social media groups, and investment clubs filled with people who share your passion for investing. Surround yourself with a supportive community that can help you along the way. Congratulations! You've made it to the end of this video, which means you're already on your way to becoming a more knowledgeable and empowered investor. Remember, investing in stocks is one powerful way to build wealth over time, but it's not the only way. It's essential to create a well-rounded financial plan that aligns with your unique goals and risk tolerance. The more you learn about investing, the better equipped you'll be to make informed decisions and navigate the complexities of the market. Investing is a journey, not a destination. By staying focused on your goals, managing your risk, and staying disciplined, you can achieve financial success. If you found this video helpful, don't forget to give it a thumbs up and subscribe to my channel for more videos on personal finance, investing, and building wealth. And hey, if you know anyone else who's looking to start their investing journey, share this video with them. Thanks for watching, and remember, the best time to start investing was yesterday. The second best time is today.